we've got a lot of fun things to talk about today. And we've got Jamie Griggs hiding behind the screen here. She's our uber talented marketing director. She's got a few polls. She started first one with, what do you think will happen to housing prices here in 2023? Can you publish that? I just would love to see kind of where, okay. So most people are thinking they'll increase and flatten. That's interesting because that's what the data is showing. But a lot of the headlines are screaming house prices to go down. So it's interesting. Steve, what do you take about, how do you take that? Do we just have more informed clients, or where are we at?
I would say that's probably an example of our clients we've talked through it with them. I think because I believe when you start going into the slides and you start looking at it, that's predominantly what you hear is the opposite. So well done.
Yeah,
well done.
So we are not the believers that house prices always go up. We believe that factual decision, housing does cycle. But what we're seeing in the data right now does not support a big housing crash ahead of us. And what's interesting is that we usually see buyer understanding of the market about 3 to 6 months after what actually happens. Because what happens is, there's a long cycle to real estate. It usually takes 2-3 months to close a property, and then for that data to be recorded and then to report it. Usually the journalists are 4 to 6 months behind, and then that takes a while to catch on with buyer sentiment in the headlines. And so what we often see happening is way ahead of what the sentiment in the market. So what was really interesting is here at the end of 2022, almost 40% of Americans felt that house prices were going to fall in 2023. But we feel that they were behind that. And when we go to the actual data, this is a couple big data aggregators, Case-Shiller, FHA, FA, CoreLogic, et cetera. What they showed is that at the end of 2022, when 40% of Americans felt that housing prices were going to go down, they were already coming back up. And so what we're seeing is that really since about February, nationwide housing prices have already recovered. And we've seen that here in Bend as well. But I just saw another headline yesterday, housing prices down by 10%, weak future projected, et cetera. And what's interesting is we need to get to why are they talking about that 10%? And what I'd like to do is quickly go to kind of what's happening in Bend so we can kind of create an example around it. So where are we in Bend? And I know that we've gotten into what does median sales price for single family homes mean? And how accurate is it? What's the basket of goods? How many above and below that median price, et cetera. But where we stand right now is for single family housing, we're at about $725,000. Yes, that's down 7.1%, but that's using a 3 months average. And we're only down about 1% if we're using a 12-month rolling average. So the data point that we're really seeing in the headlines of prices down 8%, 9%, 10%. Really what they're doing is they're doing kind of a snapshot in time of this exact month versus this exact month last year. And 2022 was really an anomaly. It was a unicorn year. It was an outlier. And it was this massive appreciation. We had 18% appreciation nationwide. And it was this unrealistic little peak. But when you look at it outside of a month-by-month basis, it's really a lot more subdued than people are saying. And we're not down 10% year over year. We're only down about 1%, unless you pick one very small snapshot in time. And historically, we often see that home prices have about a 6 to 8% ebb every year from peak to trough. So that's about normal. Usually the prices that we see sell in April, May, June are about 6 to 8% more than what they sell for in November, December, January. And so that's a pretty normal thing. And it's easy to say that now, but of course, but 3, 4, 5 months ago, Steve, they were screaming in our ears that the world was going to end and housing prices were going to crash. Weren't you hearing that?
Oh yeah, that's the predominant headline. And I think that previous slide that we had does kind of help hammer home what is actually happening on a month-to-month basis. Year over year, yeah, there's always going to be, it's a cyclical market. Every year we have it, just like you said. But it's important to see the subtleties of what are happening on a short-term basis of going up and down on a month-over-month basis. And when you do that, you see that the second half of last year was a very negative, well, not very, but it was a negative stretch of time. And even though those headlines continued, like you said, they lagged, they continued 3 to 6 months into this year. What we're seeing is actually very different. We're seeing recovery. We're seeing the market tick back up. It doesn't mean it's all roses, of course, but yeah, the data is certainly showing that it isn't quite what the headlines are showing. And we'll go into that on a few of these other statistics as well.
Yeah, so that's pricing. That's where we're at pricing. We're about 725,000 for the median single family home. It's obviously less if we take in all other housing types. And then we're down about 7% from peak. But now let's go to the next slide here. And really what drives that is inventory. Jamie, do we have a poll that we could do really quickly about interest rates and moving? Yeah, there we go. I think that'll kind of help drive this question. But Steve, I'd like to kind of hammer home what you're seeing with inventory this year, because what I've seen, even from emails from other agents, and I think it's a little misleading, is they're seeing inventories up 50% over this time last year. And a lot of people are saying if inventory is up so much, right, prices are going to go down because we have a flood of inventory. Let's talk through this a little bit.
Yeah, so inventory, just months of supply. We talk about it. That's what this chart is showing. We're talking 2.2 months. If no new homes come on the market, given the pace of selling, we will run through our inventory in 2.2 months. We've talked about this before. A more balanced market is somewhere in the 5 to 6 month range. We're definitely not there. When you look at that top chart, it looks like, oh, wow, we've come up quite a bit. The market's going to be flooded with homes. Prices aren't going to be able to hold. The bottom chart shows a little perspective. It shows what inventory has looked like for, what is that, a period of 10 years. Yeah. And when you look at it like that, you see that we're closer to half of where we would normally be. And we could do that. There's a number of metrics we can look at. New listings. This part of the year, this first half of the year is where it always ramps up. Last month, we had roughly 50% fewer new listings than we did in the pre-pandemic years. And so, you know, we've talked about this as well. Will people list their house if they're in at 3%? Will they want to get out of that? And so there are all of these factors determining whether or not someone's going to continue to list those homes and how many will be sitting on the market. At this point, yes, we've come up from the lows. 2022 was the lowest inventory we've seen as far as our data can track. So yes, we've come off of that, but we are definitely not at a crisis point with inventory. If anything, buyers are still wanting more options and they just don't have them. Yeah,
great point. And then we've done this in our previous slideshows, but when prices went down dramatically in 2007 and 2008, it took us getting up to 15 months of inventory, over 2 years of inventory before we saw a clear trend in prices going down. So we would need what, you know, how many X? 15X, no, 8X, yeah. 8X multiplier of inventory to get to that point. And then Steve alluded to it, and it came up in this poll. I want to move, but I don't want to give up my interest rate. True or false? 90% true. So that is one of the biggest things that we have going right now. There's very few times in history where interest rates double in a matter of a year or two. And given the affordability issues that we have with this high housing price, combined with a doubling of interest rates, there's not many people that want to leave their house. Those people that wanted to move up to a bigger house, you know what, at this point, they're accepting the smaller house they're living in because their mortgage payment would double. People that wanted to move down a house and move smaller house, and when they look at it, they buy a house half as much. It would cost them the same amount in the same monthly payment. So they're just being okay with it, and they're going to lock off those extra kid rooms that they're no longer using, et cetera, et cetera. So we're just not seeing the inventory that we are accustomed to. Traditionally, about 5 to 7% of real estate turns over every year. I think the last number I saw was about 2%. So just people aren't bringing their homes. And then, of course, we've talked about this. We just don't have enough new builder inventory nationwide, especially here in Bend. So what we're seeing is this is pointing towards sustained pressure, support, upward pressure and support for housing prices, whether you like it or not. Steve, do you disagree with that?
Yeah, absolutely. I mean, at the end of the day, we've said this a number of times, the housing market is based on supply and demand. That first half of the conversation, what we were just talking about there is supply. When we're talking about days on market, that's showing demand, right? That's showing how quickly are some of these homes selling. And again, we can go through a couple of things with this. When we compare it year over year, we're up pretty dramatically from where we were at the lows. We're at about 45 days. That's the average days on market right now. Again, there is distinction between the average and the median, which we can go through. But yeah, we're returning back to any of those years that we look at between 2013 and 2020. We're back in a normal range of how long it should take a house to sell. The one thing that I
Yeah,
want to point out, and the
but when a
reason
client sees a headline that says it takes 200% longer to sell a home, people, draw or, incorrect conclusions from that, right?
yeah, absolutely. And the piece that's not in here, nice timing. My there's a blower right right outside the window here, so I apologize. The thing that we need to point out about those 45 days, that's the average days on market. And when you look at the market right now, there's about 40% of the homes that are selling within 7 days. And so there is a wide spectrum that makes up that average of 45 days. There are the homes that are languishing on for hundreds of days, in some cases even over a year. But there is 40% of that market that's taking place within somewhere between 4 and 7 days of being on market. So I guess my point there is the demand is there. We're starting to have a little bit more supply, and we're starting to have a few more options for buyers. And for the reasons we discussed about mortgage rates and changes in those, if you were to get out of one and get into another, it might have buyers waiting a little bit more. But when that opportunity is right, 40% of the homes are selling within a week. And so if you're looking at lack of inventory, but still fairly strong demand, that's that dynamic that you need to have some stability in the market.
Yes, those are all good points, but the dynamics are always different, right? History rhymes but doesn't repeat. A couple years ago, when prices were going up, sellers, and there was limited inventory then, sellers would often say, I don't need to sell, there's not that much inventory out there, I'm going to price it high. And sometimes they would get away with it, and then sometimes the market would eventually work up to where they are and they would be able to exit that successfully. The dynamics of this market are very different. Housing prices have gone up in price so much that buyers are already struggling a little bit. They're a little more savvy. They're a little bit more hesitant. They're a little bit more worried about the economy, the stock market, the interest rates, the recession, et cetera, et cetera. And we're not seeing those extrapolated price houses selling. So what Steve is getting to is we're kind of seeing barbells on the selling spectrum. 40% are on the market less than a week. They're selling at 99% sale price to list price. They're getting what they're asking. Sometimes they're getting over what they're asking. They're selling real well. But then on the other end, I think that, we'd have to get the data, 20-30% of the homes on the other end, average time on market, 90, 120, 150 days. Average sale price to list price, about 90%. They're getting negotiating down about 10%. And then there's a fair amount of homes that are not selling, coming off the market, coming back on, price decrease. And so it's this really interesting world out there. And it's never been more important than to be realistic as a seller. Because if you are just sloppily throwing out there, the market, even though there's not a lot of inventory, the market's rejecting it. Steve, are you seeing it?
Yeah, absolutely. At the end of the day, the activity in the market is represented by action, by a purchase or a sale. What we're seeing, and I think we go into a few more of these slides when we're talking about the unicorn years, the number of people that are out showing homes, and the number of homes that are actually selling, all of that is happening. So I'll wait and we'll get to those in a little bit. But yeah, let's talk what's happening with interest rates. And do you want to lead this one or should I?
Well, so here's the thing. Somebody needs to put a muzzle on us or a filter, because we're going to get in. You and I could both go down a rabbit hole on this one. You being a past futures trader, we could get deep into the analytics on the spread between the 10-year treasury and the 30-year mortgage and what that spread is derived from, et cetera, et cetera. I don't want to go down that. Let's try to simplify it. But in synopsis, we're going to talk about interest rates, because interest rates are the number one factor of buyer behavior right now, because housing prices are so high. If they can afford it, they're buying. If they can't afford it, if interest rates are just a quarter or a half point too high and they can't afford it, they're sitting on the sidelines. And we're in a very tight there's a very tight correlation in this market between interest rates and buyer behavior. And what we're seeing is that there is a dramatic spread right now between the 10-year treasury and the 30-year mortgage, your mortgage on your house. And what we've traditionally seen over the last 40, 50 years is a spread of about 1.75%. And where we stand now is much different. We're at about almost 3% spread between those two. So what does that mean? That means we've got about an extra 1.5 of spread between those two data points, which means that interest rates are too high given the 10-year treasury. So what this really means is that's factoring in risk of recession, risk of inflation, all these other types of things. But generally, and I have a bunch of other charts that I didn't add in here, generally when you start get about a 3% spread between the 10-year treasury and the 30-year fixed, they start to get closer together and those mortgage rates generally start falling. There's a few outliers, the 1980s when we had hyperinflation and a few things like that, but traditionally they have. And the reason I'm discussing this is because if we were to go down to a normal spread, we would be in the low fives right now. Mortgage rates are upper sixes right now. And so even if we were to not go down to our normal spread of 1.75, even if it was 2.25, and that's why we put this chart here, interest rates would be down almost a whole point at about 6%. And what this is deriving is that we're in an increasingly likely scenario that interest rates will fall. And this is going to increase buyer activity. It's so hard to time interest rates and say exactly what's going to happen. But when we look at the history, we're seeing a lot of good data in that. And Odeda, who's the chief economist from First American, just said, it's reasonable to assume that the spread and therefore mortgage rates will retreat in the second half of the year if the Fed takes its foot off the monetary tightening policy and provides investors with more certainty, which is what we're seeing. However, it's unlikely that the spread will return as there's some risk to stay. But basically what we're seeing is that as interest rates hopefully fall this year, buyers are going to be able to afford more home, and we're going to continue to see buyer demand on an already constricted inventory. Did that summarize it, Steve?
It did. And if I could just jump in really fast on that, I just want to clarify, because what you see in the headlines are there are future rate increases down the pipeline, right? Yeah. And so what people hear is they hear rates are going up. That is a different rate. That is the overnight lending rate between banks, not the rate that lenders charge for borrowing money. So historically, it is following not the overnight lending rate, but rather the yield on the 10-year treasury. And that's why the expectation is, even though the Fed still may be raising rates a couple of times, the mortgage rate is actually expected to go down because of that.
Good point. Yeah, that's already been pretty much baked in. They the Fed has telegraphed it, and because it's not, well, yes, absolutely.
The second piece, and it doesn't involve interest rates, but it does involve the other segment of buyers is cash buyers. And so we're talking about a segment of the market. Normally, it's about 75% of purchases are finance transactions and 25% are cash purchases. However, what we've seen is with interest rates higher and people being a little bit more flush with cash, if they've had their money in the stock market, they've seen it come up between 10 and 15% in the last year. And so what we have seen recently is that number of cash transactions has been increasing. So if we're strictly just focused on interest rates and the buyers that are doing that, we are missing a segment of the market. So just wanted to throw
Great, thank you. Now, what I'm hoping to do is close the chapter on the pandemic. The reason we're still talking about the pandemic is because so much buyer and seller behavior is predicated upon their understanding of the real estate market in the last couple of years. Thankfully, we're getting back to historical norms in a lot of ways. Historical norms of inventory, historical norms of pending of sales, et cetera, of appreciation rates. And hopefully I'm going to have a few slides here talking about the craziness that these unicorns years, and I'm not saying these unicorns were good or bad or otherwise. There was painful years during the pandemic for us, for everyone. But what I want to do is kind of separate the data and how those years affected real estate, so we can hopefully start closing that chapter and getting back to fundamental real estate decisions where buyers can make calm buying decisions, not in multiple offers blind, or sellers don't have the expectation that prices are going to go up 15, 20% a year, et cetera, where they want to be the absolute highest price in the history of the market. And once we start getting back to normalcy, we can have more methodical decision making. And I think that's where we're at. So let's hopefully this will be kind of these 3 or 4 slides will be us closing the book on the pandemic. So during the pandemic, but these are nationwide numbers, and we actually saw even higher appreciation rates in Bend. But what we saw is that 2020, we saw about double the average appreciation. Historically, 5 to 7% is the standard appreciation in real estate over the last 50, 70 years. Nationwide, we saw 11% in 2020. 2021 was 18%. And there was actually one 12-month rolling window at the end of 20, beginning of 2021, when it was even higher. I think it was over 20% nationwide. So that's housing prices. What are we, let's go to the next one. Let's go to showing, let's go to showing traffic. Showing traffic was about double average in the last 2 years. And even though, and you'll also see in the headlines, showing traffic, buyer activity down 20%, 25% nationwide. That's a fun headline. It gets click-throughs. But even if we look back, that's stronger than what we saw in 20, 19, 18, 17, 16, 15, et cetera, all the way back to like 2007, 8. This is still some of the strongest showing activity that we've seen in history of real estate, but it's off of those crazy 2-year unicorn years. And then let's get to foreclosures.
Can I jump in on that one real fast, Brian?
Please do.
So if we go back to the other slide, just one thing that I did want to point out with the amount of showings that are taking place in 2022 and 2021, those unicorn years, many of those showings turned into transactions. What we're seeing now is showing activity is still strong, but there aren't as many transactions that are happening from it. Buyers have now gotten back into a position of, I don't have to make an offer on the only house that I walk into. I'm going to go see 5 or 10 or 20 houses. And so, you know, that's a statistic that hasn't come off quite as much from the highs of the unicorn years. And I believe it's kind of leveling itself out in terms of buyers being able to actually have a moment, think, compare. And so anyway, I wanted to point that out because that's anecdotally what we see with our clients. We're going to look at 5 and 10 times as many homes as we did a year or 2 ago, which is what you should do if you're buying a house.
Yeah, there was nothing I hated more than in 2020, 2021, that people would have to make an offer on a property the day it came on, put accelerating, escalator clauses in their offers. They were waiving inspection of the property. Those are when bad decisions are made in real estate. And it was so tough to try to lead a buyer to make a methodical decision. We're back to the point where they can take their time. And that has been one of the most refreshing changes that I've seen. Because those are years of greed and imbalance with supply and demand and emotion, and none of those things I don't like to play in any of those worlds when we talk real estate. These are too big of numbers. The other thing that I think that's important as we close this chapter is foreclosures, because this is another headline that we're seeing in the headlines right now, right? Foreclosures doubled over 2021. I just saw a Forbes article this morning that says, foreclosures up 50%, the world's ending, et cetera, et cetera. But by the time they read, went through the data at the end of it, it was like, well, it's really not an issue, but no one reads to the end of those articles. And what we're seeing is there was a foreclosure moratorium as part of the economic bailout during the pandemic that said, hey, you're not allowed to foreclose on anybody. So of course, these foreclosure numbers go way down, but we're still not, even now that all those have been lifted, we're still not seeing many. So we're still at about half the foreclosure level that we were at in 2016, 2017, 2018, but yet the headlines are screaming foreclosures are on the rise. And so we're at one of the lowest numbers of foreclosures in the last 20 years, but yet it's still a talking point out there. So, hopefully we can understand these were unicorn years. I would love to take them out of the data set. But they're starting to get enough in the rear view window that we can now process them with a little bit more clarity. And it was a wild couple of years trying to interpret the data with those wild fluctuations that we're seeing, but I think we're there. The other thing is we just did a poll. Jamie, would you mind publishing that poll? So what we're trying to get at is this one is saying, hey, what are the most important factors what are your most important things on your mind when you're purchasing or selling a property? Now, what I love to see here is that 71% of you, the number one was long-term financial investment through forced savings and appreciation. What was the number 2 here? Ability to improve the property, to modify, to nest. Then the next ones would be emotional, family security, long-term control over scenario, etc. And I see 0 answers on short-term appreciation return, need to sell at the peak of the market, et cetera, et cetera. But those were not factors that were being discussed the last couple of years. Everyone was, every seller wanted to sell at the peak of market. Everyone was worried about short-term gains. And it's nice to see that we're returning to some of the fundamentals. So.
Yeah, it gets us back to what we were saying earlier on. The point, what is most important to many people, to most people when they're buying a home, is not an individual's data set, an individual statistic. How much is the house going to be worth 2 months from now, 4 months from now? It's, why are you buying this? Is it for tax reasons? Is it for the stability? Is it for, a place to take a new job, to move your family, to start a new life, whatever it is? There's usually a fundamental reason you're doing it, and that's what you should be focused on. And then from there, making sure that it's wise financially.
Beautiful. So we're about done. We've only got a few last points. So if anyone has any questions, please throw them in and we'll get to them. But we're back to the point of why you own real estate. We just discussed those, from stable monthly payments to equity creation to security to financial foundation of your life. Some of the rules of success, if we were putting together this slideshow that we often go back to, it's time in market. It's not market timing. It's a long-term outlook, and it's not worrying about short-term returns. And successful entry or exit, it's not a panic purchase. It's not a top of market time sales strategy where someone is absolutely shooting for the moon. So what I'm really reassured by is that we're back to a normal market, and we get to now change the tone of what we're talking about. We get to talk long-term strategy, and it's a lot more fun, and it's a lot more fulfilling for me to help represent clients in this type of market, both buyers and sellers. So with that, we're about a half hour. Steve, I think that's one of our records. I would love to have any more interactions. Jamie, did you get any questions coming in that you think would be good to answer?
I have not seen any come through yet. So if anyone has last minute questions, submit them now. We'll get those answered for you.
Perfect. Well, then what I'm going to do is I'm going to break out early and go take a ride with my kids. It's beautiful day here. I'm looking out at Shetland Park, and I'm going to go play. So thank you all for joining us. Feel free to reach out to us anytime, benpropertysource.com. I'm sure emails have phone numbers, all that. And we'd love to set up a strategy session with you here in the near future.
Thanks, everybody.
Thank you. Take care.